Welcome to CoreLogic's housing market update for May 2019. Australian dwelling values fell 0.5% last month as the pace of home value declines continued to ease after moving through a recent low point in December last year, when national dwelling values were falling at a much faster rate. The latest housing figures take national housing values 7.2% lower over the past 12 months to be down 7.9% since peaking in September 2017. The slowing in the rate of decline is attributable to an easing in the market downturn across Sydney and Melbourne, where an improving trend in the rate of decline has been evident over the past 3 months. In December last year, Sydney dwelling values were down 1.8%, with the pace of falls progressively moderating back to a month-on-month decline of just 0.7% in April. Similarly, Melbourne values were down 1.5% in December, with the rate of decline slowing to 0.6% in April. Other property market insights are supporting a subtle improvement in housing market conditions, including a rise in mortgage-related valuations activity, as indicated by CoreLogic's platform data, an improvement in the ABS household finance data for February, and the fact that auction clearance rates are holding around the mid-50% range across the major auction markets. While none of these indicators could be described as strong, the current trend of the data implies that housing market conditions may have moved through the worst of the downturn. Although the national rate of decline has improved, the geographical scope of falling values has broadened in April. Dwelling values fell across every capital city apart from Canberra, while across the regional areas of Tasmania, Victoria and South Australia also avoided a fall. The broad-based nature of weaker housing market conditions highlights that tighter credit conditions are having a dampening effect across all markets. Annually, national dwelling values were down 7.2%. That's the largest decline since the 12 months ending February 2009, which was associated with the global financial crisis. The Melbourne housing market recorded a 0.6% fall in housing values in April, taking the annual rate of decline into double-digit territory for the first time in the history of our index, which commenced back in 1980. Although dwelling values are continuing to trend lower, the 0.6% fall in April was the smallest monthly decline since June last year, highlighting an easing in the pace of value falls during 2019. The local unit market has recorded much smaller falls relative to detached housing, with unit values down 4.1% over the past year, compared with a 12.6% drop in house values. The underperformance of detached housing is likely related to the more expensive pricing relative to units, especially considering the surge in first home buyer numbers who are generally price sensitive. Overall, we're seeing further evidence that the worst of the housing market conditions might now be behind us. Values are still broadly declining, however the pace of decline has moderated since December last year, and there are some tentative signs that credit flows have improved, albeit from a low base. Considering that tighter credit conditions were one of the primary catalysts for the housing market downturn, any sign that credit availability is improving would certainly be a welcome outcome for the housing market. According to the Australian Bureau of Statistics, lending to households for dwellings, excluding refinancing, was up 2.7% on a seasonally adjusted basis in February. Additionally, a rise in CoreLogic valuation platform activity throughout March hinted a further improvement in housing finance numbers, which will likely be reported by the ABS in their next release. Another indicator of a subtle improvement in the housing market can be seen in auction clearance rates. They're holding around the mid to low 50% range, albeit on low volumes relative to a year ago. The correlation between auction results and housing market conditions is strongest in Melbourne and Sydney, where auctions still comprise a much larger proportion of selling activity. While the mid-50% clearance rate doesn't suggest housing prices are set to bounce back, it does imply a closer fit between buyer and seller expectations, and the improved auction success rate supports the reduced rate of decline in housing values across Sydney and Melbourne. Although housing values aren't falling as rapidly as they were previously, we're still seeing values trending lower across most regions of Australia, and any recovery in dwelling values is likely to be a long-term outlook. Listing numbers remain elevated across all capital city markets, providing buyers with a wide range of choice, plenty of bargaining power, and little in the way of urgency. Capital city listings haven't been this high at this time of the year since 2012. Despite total listing numbers remaining elevated, fresh listings being added to the marketplace across the combined capitals are down 31% relative to the same time last year, indicating extremely low vendor confidence. The lower number of new listings entering the marketplace shows there is minimal sign of panicked selling. Prospective vendors seem to be comfortable in delaying their listing until selling conditions improve. The prospects for lower interest rate is another factor that could support an improvement in housing market activity later this year. While borrowers are still facing tougher serviceability assessments and scrutiny around their overall debt levels relative to their income and their expenses, lower mortgage rates will certainly be a net positive for the housing market. Mortgage rates are already around the lowest level they've been since the 1960s, and any further reduction is likely to be well received by the market. On the other hand, the federal election outcome could deliver a wild card for the housing market. A change of government could see taxation policies relative to the housing market rolled back or removed, which would be an overall negative for investment demand. According to the ABS, investors currently comprise 27% of the value of mortgage demand, excluding refis, down from 43% back in 2015 and now well below the decade average of 34%. A further reduction in investment activity without a commensurate rise in owner-occupier activity would likely place further downwards pressure on housing prices, especially across the heavily supplied, high-density sector of the market. With so many uncertainties in the marketplace, it's more important than ever to stay up to date with the latest trends and market information. Make sure you're keeping up to date with the latest facts and figures via the research pages at www.corelogic.com.au.